Hello, this is Steve Schwartz coming to you from Market Traders University and the Market Traders TV virtual studio. Today is July 24th. This week's energy market can only be characterized as schizophrenic. Tuesday, the American Petroleum Institute announced week ending July 17th supplies increasing by 3.8 million barrels. That ordinarily would have been bearish. It did send crude oil down below some short-term support, down to near the $64 barrel range, only to then pause and wait for the Department of Energy's report the following day. The DOE reported a 1.8 million barrel decrease in supply. And even while that number at first glance seems to be bullish, I want to point out to you that their total reserve that they announced Wednesday was 342.7 million barrels. That is well above the 5-year average range for this year. So therefore, long-term fundamentals have not changed. Supplies are increasing in crude oil, in gasoline, as well as decreasing in demand. People are just not hitting the road the way they did even last year when the recession was in full swing. Now, there may be recovery, but I really believe it's more hoping and wishing right now than anything else. And I'm not a doomsdayer, but I'm just going on pure facts. The 342.7 million barrels is, in fact, way above the average range for this time of year, and it should put a cap on any significant rallies. What we're looking at today is a monthly chart. This is what's referred to as an inner trend line. This is what followed the market down throughout the second half of 2008. And then we saw a consolidation period in the first 3 months of the year. Had a nice little reverse head and shoulders. This would be a left shoulder, a head, a right shoulder. Right shoulder, and then carved out. And now we have a breakout above the $60, which then finally brought us to a high of $75, as you remember that rally. But in the subsequent periods and weekly candles, you see a correction. Now the question is, are we ready for a new leg up, or are we going to roll back down? That's the key question. Well, before we go back up, let's take a look at a daily chart where, in fact, the market is bumping up against a critical resistance level. You've heard the adage, what was support becomes resistance, or what becomes a floor becomes a ceiling. Well, that's exactly what happened. As the market went up, came back down and supported $68 a barrel. Buyers bought it, supported it, won the struggle between bulls and bears, took it to another high. At that point, that high stopped on a dime, rolled back over, and once this support line was broken down, this confirmed a double top, and now the market is doing what is natural in the order of technical conditions. A retest of once what was floor of support now becomes a ceiling of resistance. So be careful. Don't think the market's going to have an easy time just running through $68 a barrel. It just may. If there is a shoe that falls off a foot, some kind of geopolitical tension, or somebody from OPEC starts jawboning the market, telling you that they're going to cut supplies because prices are too low, just let the technicals be your guide. The next chart is a 60-minute chart. And this is where the breakout took place when the Department of Energy announced their draw of supplies of 1.8 million barrels. Keep in mind that still the total reserve is well above seasonal averages. But nonetheless, the market was sitting there vulnerable of stop loss short buying, meaning people that owned short positions, traders that had short positions, were forced to take their positions back by buying back their contracts once this ceiling of resistance was taken out. Well, remember what I said. As the market now has climbed, it's now looking like it's going to roll over and maybe retest. This ceiling of resistance through this period will become a floor of support. So look for the market to come on down to 65.80 and find some buying interest. If in fact the market falls below the 65.80 with good volume, then this was nothing more than a reflection of a confusion between the two reports, the American Petroleum Institute showing an increase in supplies and the Department of Energy showing a decrease in supplies. So right in here is that schizophrenia I was talking about concerning the market, and let the technicals be your guide. If you went long in here, understood, make sure you have a stop somewhere in here so the market doesn't take your money away from you. That's good risk management. If the market goes below this support line and on good volume, it's time to get back short. Do not try to guess this as being the top. The petroleum markets are fickle, they have no mercy, and they won't with you. So let the technicals be your guide. Have a great day, and let the best trades be yours for next week.